Let's talk to Vincent Juvyns. He's an equity strategist at ING Investment Management. He joins us live from Brussels. Good to see you, Vincent. So we had disappointing growth figures from the U.S. out yesterday. We also had a surprise increase in jobless claims. And of course, oil prices don't seem to be getting lower anytime soon, going lower anytime soon. So my question is, can companies sustain the kind of earnings reports that we've been seeing?
Well, at the moment, yeah, like you say, there was a lot of reason to worry about, let's say, the macroeconomic context. Definitely seeing that that growth figures in the U.S. were lower than expected, but at the same time, higher oil price can explain a big part of this decrease, let's say. But at the same time, we see that on the macroeconomic level, companies are doing well, both in the U.S. and in Europe or elsewhere in emerging market. So that's something which strengthens our idea that we're up for a good equity year this year. Last year, when we disclosed our forecast for this year, we surprised a little bit the market by saying that we were expecting a double-digit earnings recovery or growth this year, and the same level of recovery on equity market. We still are confident with these figures. So we expect, for instance, for Europe on the Stoxx 600, Stoxx 600 at 310 at the end of the year, which is, let's say, almost more or less 10% from the current level. So I think that if the macroeconomic environment stabilize a little bit in developed countries like the US or in Europe, and like they're doing now, I wouldn't be too worried by the latest growth figure. I see it either as a stabilization than really as a downturn. I see that all, let's say, leading indicator have now reached their peak, but they're probably going to stay at more or less at current level. But I think that there's enough reason to be positive about the equities, and we've seen it in the earnings season in the US, where earnings are very good so far. In Europe, less companies have already reported, but what we have got to read is rather positive till now. So we're quite confident that the market will be driven by this earnings recovery. We expect stable valuation over the year, so we don't expect a PE expansion, but mainly driven by this earnings recovery. So let's say double-digit recovery,
Vincent?
below end of this double-digit, it should help.
Vincent, others aren't nearly as optimistic as you. Charles Dumas of Lombard Research, who we had on the program yesterday, is predicting that stocks are going to peak early in summer as QE2 is withdrawn, and then he's predicting a bear market for next year, a lot more than a correction that some others are predicting. I'm just wondering how you can be so confident when we have, for example, the end of QE2 in sight here.
Well, we should maybe confidence, maybe it's a big word. We're just expecting stable valuation and decent earnings recovery. So at the same time, it's not really an incredible target to say that we will have definitely 10% or more earnings growth this year, and taking into consideration that valuation will remain stable. I think it's quite a conservative scenario to say that equities can go up. Only based on these aspects. There's other metrics which also are favorable for equities also. If we look at current bond yield, both in the US and in Europe, we're below the 4%, while dividend yield alone on most of equity market is above these figures. So that's also something which makes that it should attract a lot of investors. At the same time, we see that there is again a lot of incentive for shareholders on the market in certain sector. I heard you talk a lot about the IT sector. We see that it's a sector where there's a lot of M&A activity at the moment, where there's a lot of share buyback programs. In other words, a lot of incentive for shareholders. So this makes me reason carefully optimistic about equities this year, and not anticipating in the near term a bear market. But of course, we can't. We will have to take into consideration geopolitical event and of course macroeconomic event. But the figures that we have got to read so far on the macroeconomic level remain strong enough, definitely in emerging markets. This is definitely going to be the engine of the world like it was last year. And we saw that leading indicator in emerging markets are bottoming out. So it's also a reason to be positive.
All right,
for
Vincent,
the geopolitical situation.
We've got to leave it there. Thank you very much. From ING Investment Management, Vincent Juvyns.